In today's action-packed video, we're diving headfirst into Dividend Portfolio Strategies, maximizing returns and earning $500 weekly. I'm laying out a high-energy roadmap to build a portfolio that pumps out cash and grows like a rocket. Here's the lineup of topics we'll blaze through. First, we'll understand the dividend landscape to get the lay of the land. Then, we'll build a diversified dividend core for rock-solid stability. Next, we'll unlock reinvesting dividends for compounding magic to supercharge your wealth. We'll boost income with covered calls to squeeze extra profits from your stocks. After that, we'll leverage dividend ETFs for simplicity to streamline your strategy. We'll also trade for supplemental income to fast-track your goals. Then, we'll manage risk like a pro to keep your portfolio bulletproof. We'll explore how to scale up with leverage, carefully, for bigger gains. We'll cover why tax efficiency matters to keep more of your money. Finally, we'll track and adjust to stay ahead of the game, and wrap it up with the $500 weekly plan in action to tie it all together. Buckle up. This is going to be a wild ride, and that secret trading tip at the end will blow your mind. Welcome back to the Trade Savvy Academy. First things first, dividends are your ticket to passive income. When a company pays a dividend, it's sharing a slice of its profits with shareholders. Think of it like getting a quarterly or monthly thank you note in the form of cash, just for owning a piece of a great business. But here's the kicker. Not all dividend stocks are created equal, and maximizing returns means picking the right ones and managing your portfolio like a pro. Our goal? Build a portfolio that generates steady income, grows over time, and gets you to that 500 weekly target, which translates to $26,000 annually. Let's break it down step by step, with strategies that balance safety, growth, and income. Step 1. Understand the dividend landscape. To maximize returns, you need to know what you're working with. Dividend stocks come in all shapes and sizes: blue-chip giants, high-yield underdogs, and everything in between. Blue-chip stocks like Coca-Cola or Procter & Gamble are household names with decades of consistent dividend payments. They're the tortoises of the investing world, slow and steady, offering yields around 2 to 4%. Then you've got high-yield dividend stocks like real estate investment trusts, REITs, or energy companies, which can yield 6 to 10% or more. But beware, high yields often come with higher risks, like potential dividend cuts if the company hits rough waters. For our $500 weekly goal, we're aiming for a portfolio that generates $26,000 a year in dividends. If your portfolio yields 5% on average, you'd need a $520,000 portfolio to hit that target. $26,000, 0.05, $520,000. That might sound like a mountain to climb, but don't worry. We're going to combine dividend investing with trading strategies to accelerate your path. Plus, reinvesting dividends and using leverage wisely can shrink that number significantly. Let's keep moving.
Step 2. Build a diversified dividend core. The foundation of any great dividend portfolio is diversification. You don't want all your eggs in one basket, because if one sector tanks, your income stream could take a hit. Aim to spread your investments across at least 5 sectors: consumer staples, healthcare, utilities, technology, and real estate. Each sector behaves differently in various market conditions, giving your portfolio resilience. Start with blue-chip dividend aristocrats, companies that have raised their dividends for at least 25 consecutive years. Think Johnson & Johnson, with a yield around 3% and a rock-solid balance sheet, or PepsiCo, which blends growth and income. These stocks are your safety net, delivering reliable payouts even during market downturns. Allocate about 40% of your portfolio here for stability. Next, sprinkle in some high-yield players, but choose wisely. REITs like Realty Income, often called the monthly dividend company, pay out like clockwork and yield around 5 to 6%. Utilities like NextEra Energy offer a blend of income, around 3 to 4%, and growth, thanks to the renewable energy boom. Allocate 30% to these higher-yield sectors, but do your homework. Check the company's payout ratio, dividends divided by earnings, to ensure it's sustainable. A ratio below 70% is generally safe. Anything above 100% screams red flags. Finally, don't sleep on growth-oriented dividend stocks. Tech giants like Microsoft or Apple pay dividends, yields around 1 to 2%, but also deliver capital appreciation. These are your portfolio's growth engines, so allocate 20 to 30% here to balance income with upside potential. By diversifying across these categories, you're building a portfolio that's both a cash machine and a growth vehicle. Step 3. Reinvest dividends for compounding magic. Here's where the magic happens. Dividend reinvestment. Every time you get a dividend payment, instead of pocketing the cash, use it to buy more shares. This is like planting seeds that grow into money trees. Compounding is your best friend. Albert Einstein called it the eighth wonder of the world for a reason. Let's say you invest $100,000 in a stock yielding 4%. In year 1, you earn $4,000 in dividends. Reinvest that, and now you're earning 4% on $100,000 to $4,000, which is $4,160 the next year. Over time, this snowballs. To hit $500 a week, reinvesting dividends can reduce the portfolio size you need. For example, with a 5% yield and 7% annual portfolio growth from reinvested dividends and price appreciation, a $300,000 portfolio could grow to $520,000 in about 8 years, assuming consistent reinvestment. Platforms like M1 Finance or Fidelity make this easy with automatic reinvestment options. Set it and forget it, and let compounding do the heavy lifting. Step 4. Boost income with covered calls. Now, let's kick things up a notch with trading strategies to juice your returns. Covered calls are a fantastic way to generate extra income from your dividend stocks. Here's how it works. You own 100 shares of a stock, say AT&T, trading at $30 with a 5% dividend yield. You sell a call option, giving someone the right to buy your shares at, say, $33 in a month. In return, you collect a premium, maybe $50 to $100 per contract. If the stock stays below $33, you keep the premium and your shares, plus your dividends. If it gets called away, you still pocket the premium and any price gains up to $33. Covered calls can boost your effective yield by 2 to 5% annually, depending on market conditions. For a $100,000 portfolio, that's an extra $2,000 to $5,000 a year. The key is to sell calls on stable dividend stocks with moderate volatility. Think Verizon or Pfizer, not Tesla. Use platforms like Interactive Brokers or Robinhood to execute these trades, and stick to monthly or quarterly expirations to keep things manageable. This strategy is like renting out your stocks for extra cash while still collecting dividends. Step 5. Leverage dividend ETFs for simplicity. If picking individual stocks feels overwhelming, dividend ETFs are your shortcut to a diversified, income-generating portfolio. ETFs like the Vanguard Dividend Appreciation ETF, VIG, focus on dividend growth stocks, yielding around 2% with low expense ratios, 0.06%. For higher yields, check out the Schwab US Dividend Equity ETF, SCHD, which targets high-quality dividend payers and yields about 3.5%. These funds give you instant diversification and professional management, reducing the risk of picking a dud stock. Allocate 20 to 30% of your portfolio to dividend ETFs to simplify your strategy. They're also great for reinvesting dividends automatically, and their low fees mean more money stays in your pocket. For our $500 weekly goal, ETFs can form the backbone of your portfolio, while you use individual stocks and covered calls to boost returns. Step 6. Trade for supplemental income. To reach $500 a week faster, you'll need to supplement dividends with trading profits. This is where things get exciting but also riskier, so proceed with caution. One strategy is swing trading dividend stocks during earnings season. Many dividend payers, like Walmart or Home Depot, see predictable price swings around earnings reports. Buy shares or call options a few weeks before earnings, aiming for a 5 to 10% price pop, then sell post-earnings. With a $50,000 trading account, a single 10% gain on a $10,000 position nets you $1,000. Do that twice a month, and you're halfway to your weekly goal. Another approach is selling cash-secured puts on dividend stocks you'd love to own. For example, if Coca-Cola is trading at $60, sell a put option with a $55 strike price. You collect a premium, say $100 per contract. And if the stock stays above $55, you keep the premium. If it dips below, you buy the stock at a discount and start collecting dividends. This strategy generates income while potentially building your portfolio at lower prices. Step 7. Manage risk like a pro. Maximizing returns doesn't mean going all in like a Vegas gambler. Risk management is critical. Never put more than 5% of your portfolio in a single stock, no matter how safe it seems. Use stop-loss orders on trading positions to cap losses at 5 to 10%. For covered calls and puts, stick to stocks you're happy to hold long-term, so you're not forced into bad decisions if the market moves against you. Also, keep an eye on macroeconomic factors. Rising interest rates can pressure high-yield stocks like REITs, while economic downturns might hit cyclical stocks like industrials. Stay diversified and rebalance your portfolio annually to maintain your target allocations. If one sector grows to dominate your portfolio, trim it and redistribute the profits. Step 8. Scale up with leverage, carefully. To hit $500 a week with a smaller starting portfolio, consider using leverage, but tread lightly. Margin accounts let you borrow against your portfolio to buy more dividend stocks or trade options. For example, with $100,000 in cash, you might borrow another $50,000 at 5% interest to build a $150,000 portfolio. If it yields 5%, that's $7,500 in dividends minus $2,500 in interest for a net $5,000. Add covered call premiums and trading profits, and you're closer to your goal. The catch? Leverage amplifies losses too. Only use margin if you have a disciplined risk management plan and never borrow more than 25 to 50% of your account value. Platforms like Charles Schwab or eStar Trade offer competitive margin rates, but read the fine print. Step 9. Tax efficiency matters. Taxes can eat into your returns, so optimize for tax efficiency. Hold dividend stocks in tax-advantaged accounts like IRAs to defer or avoid taxes on payouts. Qualified dividends from most U.S. companies are taxed at lower rates, 0 to 20%, than ordinary income, so prioritize these in taxable accounts. For trading, short-term gains are taxed as ordinary income, so focus on longer-term swings or option strategies to minimize tax hits. Step 10. Track and adjust. A great portfolio isn't set and forget. Use tools like Morningstar or Yahoo Finance to track your dividend yields, payout ratios, and portfolio performance. Review your holdings quarterly to ensure they're still delivering. If a stock cuts its dividend or underperforms, swap it for a stronger candidate. Stay informed about market trends. Subscribe to newsletters like The Motley Fool or Seeking Alpha for fresh ideas. The $500 weekly plan in action. Let's tie it all together. Start with a $200,000 portfolio. Adjust based on your capital. Allocate 40%, $80,000, to dividend aristocrats. And at a 3% yield, you'll receive $2,400 a year. Allocate 30%, $60,000, to high-yield REITs and utilities. And at a 6% yield, you'll receive $3,600 a year. Next, allocate 20%, $40,000, to growth dividend stocks. And at a 2% yield, you'll receive $800 a year in dividends. And finally, 10%, $20,000, to dividend ETFs. At a 3% yield, you'll receive $600 a year. Total dividends will earn you $7,400 a year, or $142 per week. Boost income with covered calls on 50% of your portfolio, adding 3% effective yield, $3,000 a year on $100,000, which would give you $57 per week. Reinvest dividends to grow your portfolio by 7% annually. Supplement with trading. 2 $1,000 swing trades per month add $24,000 yearly, or $461 weekly. Total income, $142 plus $57 plus $461, earning you a total of $660 per week. Trim excess profits to hit $500 per week and reinvest the rest for growth. If your starting capital is lower, scale up with leverage, or focus on trading until your portfolio grows. A $100,000 portfolio with similar allocations and strategies might yield $300 per week initially, but compounding and trading can close the gap over time. Finally, before I drop that game-changing secret, if you're loving this video, smash that like button and hit subscribe to catch more wealth-building tips every week on my channel. You stuck around, and here's the trading secret I promised. The key to turbocharging your portfolio is mastering the art of implied volatility arbitrage in options trading. When trading dividend stocks, check the implied volatility (IV) of options before earnings or ex-dividend dates. If IV is high, say 30% above historical volatility, sell covered calls or cash-secured puts to capture inflated premiums. For example, selling a call with a $2 premium when IV is overstated can net you $200 per contract, even if the stock barely moves. Use tools like Think or Swim to spot these opportunities. This tactic can add 1 to 2% monthly to your returns, pushing you to that $500 per week goal faster. It's like finding free money in the options market. That's your high-speed plan to crush it with dividend portfolios and hit $500 a week. Start small, stay sharp, and let dividends and trading work their magic. Drop your favorite dividend stock in the comments, and let's keep the wealth train rolling. Catch you in the next video.